All right, let's just jump right in. Today, we're going to unpack a really popular framework for putting together a top-tier ETF portfolio. We're going to go step by step, from the ground up, so you can see how all the pieces fit together. You know that feeling, right? You log into your brokerage account and you're just hit with this wall of thousands of different investment options. It's easy to feel totally paralyzed. So the whole point of this explainer is to give you a clear, structured blueprint to cut right through all that noise. And we're doing this entire thing with ETFs. For anyone who's kind of new to them, just think of an ETF as a shopping basket. With one single purchase, you can instantly own a piece of hundreds or even thousands of different companies. It makes building a diversified portfolio incredibly simple and cheap. Now, this is our game plan. I want you to think of your portfolio like you're literally building a structure. We're going to start with a massive, solid foundation. Then we'll add some strategic tilts to get a little extra performance. After that, we'll bring in some diversifiers for stability, and finally, we'll look at a totally optional layer for income. So let's start from the bottom up. The foundation is by far the biggest and most important piece, making up somewhere between 50 and 70% of the whole thing. Its job is really straightforward. Give you broad, reliable exposure to the biggest and most stable part of the market. We're talking large-cap U.S. stocks. And you really can't talk about a portfolio foundation without talking about the S&P 500. An ETF like VOO is the classic core holding. I mean, Warren Buffett himself recommends it for most people, and for very good reason. It's delivered nearly 15% average returns every year for the last decade, and the cost is just ridiculously low at 0.03%. But here's the catch, and it's important to understand this. It's pretty concentrated. The top 10 companies make up a whopping 40% of the entire fund's weight. Now, to complement that S&P 500 base, you could add a large cap growth fund, something like SCHG. This is designed to give your foundation a bit more performance punch, and it's delivered, averaging almost 18% a year. But look at the trade-off. It's even more concentrated. The top 10 holdings here make up nearly 60% of the fund. And see that 55% overlap with the S&P 500? That means you're not just diversifying, you are intentionally doubling down on the biggest, fastest-growing names in the market. All right, our bedrock is in place. Now it's time to get a little more strategic. This next layer, making up about 20 to 40% of our portfolio, is all about what we call tilts. These are targeted investments designed to potentially juice our returns, to hopefully get us above and beyond what the broad market is doing. And our first challenger here is a fascinating one. It's a momentum ETF. The strategy is so simple. It looks at all the stocks in the S&P 500 and invests in the ones that have had the strongest performance recently. It's basically a bet that winners are going to keep on winning. And this table just lays out the results perfectly. Compared to just owning the whole S&P 500, this momentum strategy has delivered over 3% more in average returns every single year. But, get this, it's also provided better downside protection. In its worst year, it was only down 10% compared to 18% for the S&P 500. Its biggest drop from a peak was also smaller, so it's captured more of the upside while actually protecting you from some of the downside. So what does that actually mean in real dollars? Well, here's the knockout punch. Over the last 10 years, if you had invested $100,000 in that momentum ETF, it would have grown to $523,000. That same $100,000 in the S&P 500 would be worth $397,000. That is a massive, massive difference. And this whole tilt strategy isn't just for the big companies. You can apply the exact same logic to other parts of the market. You've got things like mid-cap momentum or small-cap value. But the key thing to notice here is that both of these have a 0% overlap with the S&P 500. That means they are adding true diversification to your portfolio, all while targeting historically high returns. Now, for the most aggressive kind of tilt, you can get laser-focused on specific sectors. And I mean, the returns have been absolutely astronomical. The tech sector's averaged over 22% a year for a decade, and semiconductors over 30%. But this comes with a huge warning label. These are incredibly concentrated and can be super volatile. That semiconductor ETF, for example, has 73% of its entire weight in just 10 companies. This is the definition of high risk, high potential reward. Okay, we've built our foundation and we've added our growth engines. Now it is time to add some insurance. This next layer, it's about 5 to 15% of the portfolio, and it's all about diversifying away from U.S. stocks to protect the whole structure we've built. And honestly, it's really easy to ignore this part. Why?
Because for the last decade or so, the US market has been the only game in town. It has absolutely crushed almost everything else.
But history shows us over and over again that market leadership is cyclical. There have been long periods of time where international stocks were the undisputed winners. Betting that the US is just going to outperform forever is a really risky bet against history. And you don't even have to look that far back. Just look at the last year. A broad international ETF like VEA grew 32%, more than double the S&P 500's 15.5%. This chart is the perfect reminder of why geographic diversification is so important. And beyond international stocks, you can add other assets that just move to the beat of their own drum. Gold through an ETF is a classic example. And for those with a higher risk tolerance, a small allocation to Bitcoin can add a modern digital asset to the mix. Okay, we've made it to our final layer, and this one is completely optional. This is for investors who are specifically looking to generate regular income from their portfolio. For younger investors who are focused purely on growth, this might not even make sense because of something called tax drag. That's when the taxes on your dividends can actually slow down your overall growth potential over time. But if income is your goal, here are two of the most popular options. SCHD offers a really high dividend yield, but its total returns have been a little bit lower historically. DGRW, on the other hand, has a lower yield but has actually produced higher total returns, though it does have a lot more overlap with the S&P 500. So it's a trade-off between getting more income now versus potentially more total growth later. And there you have it. That's our complete structure. You start with that big, solid foundation of large U.S. stocks. Then you add strategic tilts for some extra growth. You layer on diversifiers like international stocks for protection. And finally, you can add that optional dividend layer if you need the income. Now, this is super important to remember. This is just one framework, one way of thinking about building a portfolio. It is not universal financial advice. You always have to make the decisions that are right for your own personal situation. We've covered a lot of ground, from that stable foundation all the way to those aggressive tilts and global diversifiers. So the question I want to leave you with is this. Now that you have the blueprint, which of these building blocks is most interesting to you? Which one are you going to go start researching?